Welcome to the Dividend Talk podcast, episode 106, a CEO's perspective to dividend growth investing. Hey guys, welcome back to another episode of Dividend Talk. Today, European DGI and I are joined with Matthias, who is the CEO of DEFAMA. He talks about how we became a CEO, a little bit about why we should maybe think about investing in the company, along with some of the risks. All that and more. See you on the inside. Hey, European DJI. I can tell by the smile on your face, but how are you doing this Friday afternoon?
I'm doing well because, of course, I'm really excited because we have Matthias Kungler CEO from DEFAMA on the podcast today, and I think it's really nice because many people have been asking us one time to also get a CEO perspective on Dividend Talk. So, yes, I'm really happy with this.
Yeah, I'm quite excited, and Matthias, thank you so much for joining us, and welcome to Dividend Talk.
Yeah, you're welcome. I just have to give you a little correction. My surname is Schrade. Kugler is my nickname on Twitter, which is relatively famous. So I'm used to be called that also in private sometimes.
So maybe just before we get started, we normally go into the news of the week, but for those listeners that may not have heard of you, because we have a lot of listeners actually from the US, can you just give us a brief overview of who you are?
Yeah, I'm CEO of DEFAMA, Deutsche Fachmarkt AG, which is a listed company. We are investing in retail parks, small retail parks, typically in small towns, with local supply centers, like, for example, supermarkets, a small DIY store, or a beverage store, and also site tenants like bakeries and all that. We invest in those. We have 58 of them. We have bought 8 this year, and we try to keep them and get in double-digit yields, which was quite successful last years.
Awesome. I can't wait to get in a little bit deeper later on. So we have lots of questions for you. But before that, we have something that in the news, European DJI, that might be of interest.
Well, yeah, I think, we talk a lot about investing, right? And many people know that I've got a lot of shares in oil stocks and oil and gas, like Royal Dutch Shell, right? And, this week, of course, was really in the news that, I believe it's Gazprom is the owning company of Nord Stream 1, that they are doing their annual maintenance. Yeah. And now there's a shockwave of fear going through the news and through the media that they might not turn the gas supply on. And people are, of course, wondering what will happen this winter. And even before it was in the news, I was already talking with my wife this week, like maybe we should reorder the room for the winter, because we have a chimney. If there would be really no gas supply, how would that work? Where we would put the bed from the kids, because the last thing we want is like support this war with Ukraine. So I would be totally fine with not having gas and sit in a cold house. We'll make ourselves warm, right? Of course, there will be a climate impact, but it's 2022, and I don't know about you, but I never experienced a foreign threat or something like that. So just to think like this for me is already a realization, like this world is going mad at the moment. The good thing just is that the dividends of Royal Dutch Shell are, of course, coming in, and the profits are good. So, it sounds a bit cruel, but on the other end, like, it's easier then also to take a sacrifice to support our friends in Ukraine, right?
Yeah, that depends on your situation. Yeah, so we're, I would say, quite privileged. We've got lots going for us, good jobs. We've got a stable home, and we could probably afford some other form of heating. That's not the case for a lot of people in Europe as well. So the fear is quite real. So it's concerning. Look, I hope it's just gamesmanship, and I know Russia are playing games, and there's a whole political environment there that I don't want to get into, but I hope that they turn it on and that we don't have it, because I think Europe will suffer if we don't have gas this winter. Okay, so Matthias, usually what we do just before we get into asking you questions, we have this rapid fire round. It's just to loosen us up a little bit. European DJI is going to ask you 5 very quick questions. They're real easy, don't worry about it. And you just have to answer off the top of your head straight away the first answer that comes to your mind.
I do my very best.
Okay.
And then afterwards you can clarify, of course. So let's
Okay.
get started, Matthias. The first one: Elon Musk or Satya Nadella?
So the second one I didn't understand, but always the second one.
The second one is the CEO of Microsoft,
Okay.
Satya Nadella.
Yeah, absolutely. Yeah. I'm sorry, but I don't really like Elon Musk as a person concerning his attitude, as he's not reliable. I don't know how good he is at tech things. At least he founded several very successful companies, but I don't like him as a person, and I wouldn't go to dinner with him.
Good. I can resonate with your answer. Then the next one: would you rather be acquired or merge with another company?
I think if I had to choose, I probably would say I would be acquired, and after that start again on my own. Merging is a very difficult thing. If you, it depends very much on with who. If it's someone who has the same thinking, the same mindset, and I think it's very, very difficult to find someone you can merge with and work together as equal. Most mergers in the stock market fail. Like prominent ones like Daimler and Chrysler, for example, which was a mentality problem on a big thing. I think you have a chance if you have a similar company, a similar size with a similar structure. But as the bigger the companies get, the higher the risk a merger will fail.
Yeah. The next one is then pizza or bratwurst.
I think my Twitter follower would be very, very disappointed if I said bratwurst. In fact, pizza is what I do on my own, so I choose pizza. But they also might be disappointed if they see there's a famous station on the A9, the route from Berlin south, which is not official dining, what's it called, restaurant, but you can buy bratwurst, a sausage over the fence which has been installed there. It's really crazy. You have to Google that. You have to see that. But as I got to know this place, I always stop there if I go to direction south, direction Munich. I think I've been there at least 10 times, 20 times or so. That's a tradition, and mostly I also take a picture and Twitter that.
Nice, awesome. The fourth one: Deutsche Bank or N26 Bank, this online bank.
I think if I have to choose, probably I tend to N26 as a more dynamic version, modern or something. But in fact, I don't like that. For example, they are not really not very behind or not keeping their customers clean. There are many frauds using N26 by mass mails and something. I got that in 2 or 3 cases already, and it's I don't know whether it's just a coincidence, but it was several times that it was N26, so they don't seem to care that much that they have really clean customers. But I don't have connections with both of them at the moment. So I would be a completely new. Deutsche Bank is, of course, well established, but also has had several scandals and all that. Difficult choice. So
I did some background and I read somewhere that you're not the best, always in favor of, let's say, the banking system and such.
Yeah.
That's why the question. And then the last one.
What problem as an investor, if I may add that, some of you might know that I've been a former financial analyst at GSC Research a few years ago. And we also had a database where we put in all the balance sheets of all German companies and the biggest European and international companies. And what I will never forget is that to get in the balance sheet of Deutsche Bank, simply for Deutsche Bank, we had to create 5 different additional data points, so to speak, which were not in any other balance sheet. So it's a very, very complex balance sheet, which is something I don't like if I invest in companies.
Yeah. I analyzed your balance sheet and I can see why you say that.
Yeah, it's
Nice.
a little bit easier to understand than Deutsche
Definitely.
Bank or also other financial institutes.
Yes, definitely. And then the last one, it's also a little bit probably a reference to history. Pirates of the Caribbean or Robin Hood?
I think probably more than Robin Hood.
Thanks. Yeah, I read that you were
The
part of
old
the Pirates
Robin
Party. in the
Yes,
past.
okay, yeah, but that Pirates of Caribbean, actually, I didn't see the film. Of course, I know the film, but I have never seen it. It's not my kind of humor, I think. And Robin Hood, I know I don't know whether you know that. There's a comic Robin Hood with animals, which I like very much. I saw that 25 years ago as in my youth, and I think that's a very sympathetic kind of stealing money from others.
Thank you so much, and it's a nice insight as a warm up. So Matthias, maybe you would like to, how is it? Yeah, let's get started. Just like, how did you become CEO of DEFAMA, and how did you found, and why did you found this company?
Yeah, as I founded DEFAMA, it was easy to get the job. Of course, I was, as I already mentioned, a long-time financial analyst at GSC Research. Then I had a political career, would be too much. I was member of Pirate Party Germany and got in the board for 1.5 years. While there was the hype in Germany, so I was there while there were those regional election successes first in Berlin, after that in Saarland, North Rhine-Westphalia, and Schleswig-Holstein. So that was a really exciting period. But as they started to decline, I already saw that that won't be a success story on the long run. There were great strategic failures, and so I didn't see a perspective in that. You have to know that it was all completely without payment. So it was a 100 hours job. In fact, I don't exaggerate that. It was really 100 hours a week without payment. And of course, you can't do that on the long run, especially if you don't see a use in that, if you don't see a perspective. So after that, I was looking for, as you always say, a new in German you say Herausforderung, a new potential career. Yeah. I was for a short time at a Munich based company, which is also doing in real estate. And in this company, I found that it's quite interesting segment with small retail parks. The main or the stakeholder shareholder of the company had a different mentality from me, so that wasn't for the long run. But after that, I decided to found a company in this segment and build that up in the way I think it should be done. and that's what I do for close to 8 years up to today.
That's quite inspiring. But I'm curious, as your first, as a CEO, you have to do investor calls and annual reports. Your very first one, what was that like? I'd say you must have been nervous. It must be hard.
Not really. As I've been on the stock market on the other side for many years, I know what how investors think, what we like to see. So it wasn't that difficult to fulfill the expectations. Also at the beginning, we were able to build a story before having to take in the first investors at the first capital rise. So that's not that difficult. Also, my company, GSC Research, also had external investors. It was a non-listed AG, but also with around 100 shareholders. So it wasn't new for me to do an annual report, to do annual shareholder meeting and all that. I was used to that for many years before founding DEFAMA.
So you've been pretty much on both sides.
Yes.
So what kind of investors do you prefer as shareholders?
Long-term investors. I like investors who are good informed, as we don't have things that we try to hide, which is not in every company. Of course, we also make mistakes. We also have weaknesses. We also have risks and all that. But I don't mind to talk about that. Or if someone asks us critical questions, I try to answer it on my best knowledge. And there will be times, or there have been times, the stock goes down. There will, maybe not yet, but maybe one day the earnings might decline. You have to stand to that. And if you're honest on that, you don't have to be afraid of investor questions. I know that many companies don't go to the stock market or are trying to sneak around several things, don't talk honestly on everything, try to do a lot of buzzwords to have a kind of a foggy story, so they can. But you just have to admit that no company is perfect, and if you try to be a good company, an honest company, you can have a relatively smooth calls with analysts or with investors. Of course, it helps if the company is successful too, which is not that difficult if it's a small company. If we are one day 10 times today's size, it might be more difficult to still create growth, still keep the margin and all that. But fortunately, we are relatively small, and it's not that difficult to stick to the road today.
Yeah, and here at the podcast, we have discussed so often the CEOs, specifically when you see the numbers are telling a different story than the CEO is telling. I think we have spoken several times about IBM here as an example, which is always saying like, actually one time we put all the annual reports, the press releases after each other. And the first year it was like artificial intelligence. The second year it was blockchain. The third year it was always a new growth opportunity, and nothing came to realization. So yeah, for long-term shareholders as us, it's just, I don't know why they even do this. It's just annoying people and just alienating shareholders to be even an investor, I would say.
For us, it's quite simple. If you look at our presentation, our company presentation, which is on our website, on the one hand, you can really see all presentations we ever gave since the foundation of the company, from the first conference, I think 7.5 years ago, up to today. We never deleted any of those information. And if you look at that, you will see that the first page of our presentation has always stayed the same. The bullet points have never changed because we didn't change our strategy from the beginning. And that, I think that's one thing which I learned as an analyst. I like companies which stick to their strategy. Of course, you always have to modify that a little bit, maybe. But for example, we will never buy hotels or something like that. We will never try to double our portfolio within 1 year or something. So get an exponential growth that's not healthy. On the other side, we also won't sell half of our portfolio just to get a huge one-off or something like that. And it's much easier to understand the company, to project the development of a company as we are, as for example, some companies in those let's say dynamic markets who change their strategy every year or every presentation and tell new stories every year. Some investors like that. Some investors try to ride those trends. I prefer investing in a company that I don't have to look at 5 years, and I'm still if I look at a new in the company for after 5 years, and I still see, okay, everything has gone very similar to that I expected 5 years ago. That's my preferred investment.
And I can see also in the reports that you have several metrics that you really look at, and one is funds from operations. Is this also the reason why you are really always reporting funds from operations?
Yeah, fund from operation is for real estate investors is in fact the earnings of the branch, which is there's no one-offs, for example, from sales, or on the other hand special write-downs or something if you have all that. So it's the pure cash flow, so to speak. I think it's also relatively reliable. It's not so easy to manipulate FFO, but by one-offs, of course, there's always, if your fraud can manipulate everything, but it's more difficult, for example, like earnings or NAV. The NAV, if I talk aggressively to the valuator, I probably could rise the NAV 20, 30, 50% above what is realistic, and that is still you can still get through that at the market and also with the auditor and all that. FFO is much closer to the reality typically. Also, I think as we buy and hold the real estate, it's not so important if the value is on paper higher or lower. It's much more important how strong is the cash flow. For example, empty supermarkets also, of course, have a value, but they don't have any cash flow. So a portfolio consisting of an NAV of 20 million, which is 20 empty supermarkets, is for me not the same worth as a portfolio of 20 million, which has an FFO of 2 million.
Yeah,
but would on paper have a similar valuation.
It's funny that you say that, because as dividend investors, we look actually similar. We are interested in the dividends, not so much on the daily price ticker and what the share price is doing, right? We are interested mainly in the cash flow that is coming in, because we want to cover our expenses as private investors. So
I also built the DEFAMA a little bit I, as an investor, would like to invest in that. That was from the first place. Of course, we don't do things just because the stock market likes that way. If it would be a good decision, we also, of course, would sell. We also had a sale last year, a first sale in our company history, and we will have additional sales. And if tomorrow someone does a huge offer, a completely crazy offer for half of our portfolio, probably we would take it. But that's not what we are aiming for, and it's not very probable. It's not that someone just stands in the door and says, "Here, 20 times FFO for all you have." That's not realistic. if someone does that, you're welcome. That was the thing you asked at the beginning.
Yeah.
Getting acquired, take the money and start over again.
Cool. So you spoke about long-term investors.
Yes.
What are your long-term growths in your company? So where do you see yourself in 5, maybe 10 years time?
Yeah, we did a 5-year projection 1.5 years ago, which seems relatively reachable already today. So we have a 5-year a DEFAMA 2025 projection, which what we said is getting to an FFO per share of €2.50. We already announced that we might get new projections, new guidance after our half-year figures. So I won't talk too much on that. But I think our goal is to get a solid growth every year. We don't have a fixed growth rate. There might be years it wouldn't be clever to pay every price just to get growth, to get additional retail parks. But it might also get extraordinary chances to get more acquisitions within 1 year. And if the prices go down, for example, now as interest rates are getting up, that might lead to more chances. We just look at that and react on that. But we have a relatively linear growth the last years. We didn't have very strong or very weak years already. It was, but it wasn't planned that way. It's not predictable. It was a lucky thing that it was relatively, I think, plus minus 15 to 20% every year. But you can't be sure to get that road the next 10 years.
Yeah, and you certainly seem to be on track in that projection. But what do you see then are the main risks involved in growing this business?
I think one thing that we also do, because I look at that as an investor, is we try to reduce risks on every possible part. For example, we have a very long fixed interest, in average close to 7 years, which is, as far as I know, the longest of all listed real estate companies in Germany, at least concerning B2B real estate. I think there are few companies in the residential area which are relatively long financed. But most of other companies in similar retail park or something have much shorter financing. We did that, as we always said, we can't project interest rates. Nobody knew when interest rates might get back to former highs. So we want to get rid of that risk as far as possible. So we always had a fixed interest at the beginning of at least 10 years. And now in average, we have 7 years over the portfolio. That's one thing. We also have a very broad number of financing partners. We have 58 targets, and we have already 35 different banks which are financing our portfolio. So no clump risk on that. Also on the tenant side, our biggest tenant has, I think, 11 or 12% of the whole rents, which is also split into several locations, several different brands. And the biggest single tenant, the biggest single lease term we have is just about more than 5%. We only have one lease term with more than 5%. And if we grow within the next, let's say, 6 to 12 months, probably we'll get below this 5%. So also no clump risk on that. We have a very broad regional distribution in no German country. We have more than, I think, 8 or 10 of our properties. So that's not, for example, all that around Berlin or something like that, which is also might be a risk if this region is going down. So it's very, very anti-risk structures. I think reality is the biggest risk is a big client declaring bankruptcy, which is not very probable at tenants like Edeka or Aldi or Lidl or similars. We had a few tenants who had to declare bankruptcy, but we were able to replace the tenant immediately. In 2 cases, the biggest 2 were a company called HWG, which had I don't know what's it called in English, Sanierung. They wanted to continue the lease term, but with reduced rent, we declined and took in another tenant. And we also another fashion company called Miller & Monroe, formerly known as Charles Vögele. We had also taken in immediately another company. So there was relatively few losses on that. But if, for example, in a very, very dramatic scenario, Aldi would declare bankruptcy, that would be a huge impact, as we have, I think, 4 to 5% of our total rent with Aldi. But probably most of those locations would be taken over of other food companies immediately. But it would be really a big thing. It's not
if Aldi gets bankrupt, I think many people in many countries will have issues because it's also a low-cost provider.
But typically, there were a few similar situations. For example, Kaiser's Tengelmann closed their stores, but most of them, especially the good locations, were taken over mostly by Edeka or by Rewe. At the moment, the brand Real, which was formerly owned by Metro, is also getting out of the market. Most of the Real markets will be with Kaufland or Edeka. One of our newest acquisitions was in Wolfsburg, Nordsteimke. We bought the Aldi market and several other tenants, and directly next door is a Real market, which has been taken over by Edeka. Probably will be teared down and completely rebuilt as a new Edeka market. But also some Real markets will simply close, and there will be no other tenant. For example, if you had a Real market in our portfolio, we would be probably a little bit scared what is happening to that. But if you look at the location at the beginning, if you have good locations, even if you lose a tenant, you're probably able to replace it. We have just lost one anchor tenant, was a Penny in Merseburg, and we were able to replace it with an Action market with a little bit lower rent. But still, if you have the new yield is about, I think, 11% on the initial purchase price. If that's our biggest problem we have the next 10 years, we're very happy.
Exactly.
We've got about 5% of vacancy. Most of that is in 2 of our last acquisitions in Nordsteimke, in the upper floor, and in Gardelegen, which had about 40% of vacancy as we bought it. Now we're close to 20%, and we are relatively optimistic to get the rest closed within this year. So we don't have vacancy problems in our portfolio at all.
And thank you also for mentioning this about the risks, because we notice in the investing community, people are not talking enough about risks, at least we are retail investors, right? So we usually look at the opportunities and less at the risks.
Yeah.
But also I studied your website today, the whole investor relations website. And I just want to say that's really easy to read, because your whole business model is really easily explained. You talk about how the importance of a low purchase price is. Yeah. When I read that about, for instance, below 9 times the annual rent, and I said also about the lease structure and such, it just tells me that's a really conservative approach, and that there's kind of, how you say it, like you just mentioned, with the 11% double-digit yields, that just makes it for me as an investor really easily to judge your company effectively. And I would recommend also the listeners, if they are interested, really to just spend half an hour on your website. I think they already catch most from already the front page around this.
So that's what it should look like, because if it would be that easy to get double-digit yields, everybody would do it. There are very good reasons why not everybody is doing it, and why some who try to do that fail. The problem is, as I said, you have to look very close at the beginning. We also have plenty of offers every year, hundreds of offers, and sometimes also looking at first looks very good. Sometimes we have things like 6 times net rent, so 16% yield seems crazy, and it also is crazy because typically there is something wrong with that. Sometimes there isn't, but mostly there is. We decline several of those offers if we see too high risks, especially if the main thing is always if the actual tenant moves out. What is our idea to do with the location? Is there, for example, if it's a food market and he's leaving the building, mostly he will do that because as a food market it doesn't work. So it's very difficult. If Aldi moves out, probably Lidl won't move in. Very often Aldi will move out to build a completely new building across the road. And of course, if you have the old market from 1990 and there's a completely modern new Aldi on the other road, you won't get in another food market in your building. Of course, you also can tear it down and build a new Lidl market. Sometimes that might work, but as an investment, of course, it's not very attractive. So you have to find a solution. For example, as I mentioned, Merseburg, the penny market has moved out. The food market is gone. It might have been possible to move in another food market, but as an Aldi market is close to that, it was relatively attractive, for example, for Action or other non-food discounters to move in. And if we have such idea at the beginning, we can buy it. If we don't have a good idea on that, we just leave it away. And sometimes, if you have good ideas, you also might, a few years later, this idea might not work. Fortunately, we didn't have this situation yet, but one day we will have that. That's one thing. Another thing which is very complicated in Germany is a building right. You can't imagine that. I only can say it's German bureaucracy. So, for example, if you have a food market and you have another idea, like, for example, Action market, a non-food discounter, a textile store, or something like that, and you have a tenant who likes to subscribe a new lease term, it's not that unrealistic that you may not take him in because of those building right things. There are things like so-called zentrenrelevantes Sortiment. So that's things you only may sell in the city center. And as retail parks often are located at the edge of the town, so to speak, you often may not move in, for example, fashion stores, for example, stores like Action, which have household things and all that. So you may have an idea, but in fact, in Germany, often it's not allowed to do that. And you must be very careful to get that, to don't get some of those things. For example, in Eberswalde, we had an empty Schlecker store. Schlecker is a very famous brand who got, I think now it's close to 10 years that they declared bankruptcy, had thousands of stores in Germany, luckily relatively small ones. In Eberswalde, it was only 220 square meters. There was a fashion store, Kick, is door to door, exactly next door. And our idea was just take out the wall, extend the kick store, and everything is fine. Very easy, you should think. It's not allowed in the building right. We tried that for 1 year. After that, we gave up. We tried other things, and finally we ended up in getting in a small pet store. Also, nice addition on this place, but you wouldn't believe why is this textile store with 400 square meter. That's okay, but it may not extend to 600 square meter. That's Germany, and that's building right. If in this case it wasn't very difficult to find another tenant, but there are still empty Schlecker markets in Germany, hundreds of them probably, which are not allowed to be used for other things than this segment. And Rossmann and DM, yes, they don't take those small units. They have much bigger units today, so they won't get in there. And you are often not allowed to get another tenant in. So you also have to deal with that. You have to know that. Private investors who just see the good yield of 8, 10, 12% might buy a target. We will decline because we see this risk, and sometimes a few years later, you know why you didn't buy it.
So what about from your shareholders? What would one typical misconception about DEFAMA that you would like us, our shareholders, to understand a little bit better?
I think in the actual market, it's a very big thing that everybody thinks that the increasing interest rates is a real problem for us because it's so for most real estate companies. We have the comfortable situation. We have around 10% initial yield with our tenants, and we had financing around 2% in average in our portfolio. Even if that doubles, or in a really horror scenario triples to 6%, that still works. 10% is still a comfortable difference to 6%. Of course, the yield is the margin would go down, but the business model is still possible. Probably prices would also go down, so we wouldn't be able to buy at 10%, probably rather 12 or maybe even 15% initial yield, as it was a few years ago in 2009 after the banking crisis. DEFAMA unfortunately wasn't at the market at that moment, but I know other players in the market who could buy at crazy prices and also financing that at higher rates, much higher rates as today. But for example, housing real estate doesn't work at 4% if you have prices at 30 times net rent. That's simply, that doesn't work. Also, what is very important to understand is inflation. We profit of that because our lease contracts typically have so-called indexations. In German, you call that a Wertsicherungsklausel, a kind of value security contract. So typically, tenants like Aldi have, for example, if the German VPI, Verbraucherpreisindex, I don't know if there's a similar English shortage of that.
CPI.
The CPI is rising, for example, 10%. We may increase our lease at, let's say, 5 to 8%. That's a typical structure. So that we just have to say we get more rent now, and the tenant has to pay that. We don't have to negotiate that.
Yeah,
so
super.
At the moment, if the inflation would stay around 6, 7, 8%, and yield is, let's say, from 2 to 4%, in fact, that's a better situation for us on the midterm, as if we have inflation of 1.5% and 2% interest. If you get a dividend, if you get a DCF model on that, you will understand that very easy, because in few years the increase of our rents is so much higher than the higher yield of the interest rates, I don't hope that it stays like that, because for all of us, even especially those with lower income, it's a real problem with high inflation. But for us, in fact, we are crisis winners, so to speak.
Nice.
So that's a thing that you really have to understand, and that is one explanation why our share didn't get down that strong, much, like, for example, Vonovia, which has, I think, lost close to 50%. We have around 15% from our highs.
Yeah. Super. So shifting a little bit, Matthias, because we thank you so much for this insight, and I think really also for people that have shares in DEFAMA that are listening, I think it's really helpful. But before we go to the listeners' questions, I wanted to ask you, what is your perception about dividend growth investing as a strategy, as an investment strategy?
Yeah, I like companies who pay dividend and also growing dividend. But I also accept companies which invest in their growth, at least in the first few years. I like more established companies with growth, with profitable growth, than start-up companies, as it's much more easy to evaluate them. It's easier to project a company which has always had 10%, 20% growth the last 10 years. Then get a company which is doubling their revenues last year and the year before, but still deep in the red figures. And you can't be sure that they grow fast enough and they get the J curve into positive yield. Sometimes also companies get weaker margins as they grow. Because the competitors get in. So it's, in fact, I like growth, but on a stable base, so to speak.
Yeah. Super. Thank you. So with that, Matthias, let's go to some of the listeners' questions. And I said, one of the questions was from Mark, and he has a specific question. He sent it already last week to me, and he asked, Matthias, you yourself bought some more DEFAMA shares recently, and he's wondering, like, what are the key metrics for you, and how do you calculate yourself the fair value for the company?
Yeah, good question. It's not. I don't have a really fixed price, what I say, or fixed metric, what I say. That's the fair value. Also, of course, that also always depends on the market. In the actual stock market, of course, all valuations are lower. I always stick on the FFO per share, and I must emphasize per share. That's our main figure. We don't want to grow as a company as fast as possible by doing capital increases every year. We prefer growing a little bit slower, but more profitable for the existing shareholders.
Yeah.
So if I see the share price going down, we were below 12 times net, below 12 times running FFO. In my eyes, that was relatively attractive, especially as we see potential to increase the FFO per share with our existing funds, probably much more than what we already have. We see extraordinary chances in the upcoming market. Probably, if other not so good finance companies have to sell their real estate, that might get us to a stronger growth. So, in fact, also on that side, I think we might profit on the market turbulences. But I don't. If I was an outside investor, I would look at FFO per share as a main guidance. But it's relatively difficult because also, for example, NAV is in the real estate market also always a figure. In that thing, I would say you don't have just to look at a reported NAV, because it always depends on how aggressive this NAV is. So in our case, I think it's a relatively conservative NAV. you could easily sell our portfolio at a higher valuation. There are other listed companies, I don't want to drop names there, which it might be very difficult to get the portfolio sold at the NAV, which explains sometimes why they are trading below NAV level. So I think you always should look at FFO and a little bit on that it's not too far away from a realistic NAV in the market with realistic prices. If we would offer our whole portfolio in the market, we would easily be able to get, I think, 15 times or more net rent, and that would mean an NAV per share of more than 30 euro. We are trading at about 24, 25 at the moment, so that's in the green area, so to speak. I don't think that we are overvalued on that. On our published NAV, we are trading about, I think, 20% higher, as it's relatively conservative.
We also did some preparation for this show to calculate our own fair value, and we use a discounted cash flow model for that. I can tell you that if we take your FFO per share as well, right, into consideration, and if we have a terminal multiple of 12 and a discount rate of 12.5%, and I used the first 5 years conservatively, looking at past performance and your actual performance of 10%, and then 6% thereafter, my fair value comes to 22.24 euro at the moment, which kind of 22.24 euros.
Okay.
If I go more optimistic and use your recent performance, right, of the last few years, which is more around, let's say, 14 to 18%, I come to around 29 euro for a fair value estimate. So depending on how bullish I would be or how bearish, I think personally, from what I've seen, the company is trading at a good price.
Yeah, I think that shows even if in relatively realistic expectations that you have a broad range of possible share prices. And of course, we work at getting probably at the upper end of that because of the performance. I'm not really a fan of trading at a expensive valuation, because that always risks that shareholders who buy the share get in the red area just because of a lower valuation, and you can't do anything against that as a CEO, because if you just follow the road, that doesn't allow a 50% share price increase every year. So it's not healthy if the share price is at levels like, for example, Tesla. You can't fulfill the expectations which are in those share price.
Yeah, makes sense.
Not if you don't try to overtake yourself by getting extraordinary risks, and we won't do that.
Yeah.
So I'm not too unhappy that the share is not trading at 30 euro, 50 euro, whatever, something like that. In the short term, it looks very nice, and everybody says you're a great guy, but someday the share must go down to a realistic value. So better it's trading around a realistic value. I think what you was quite funny. The two numbers you mentioned between 22 and 29 was about a trading range within the last 6 months.
Yeah, and I think it shows it shows the difference between a bearish and a bullish sentiment. I think, yeah.
So we were a little bit over this 29, and we were a little bit under this 22. So in fact, we have reached both ends of this range, which means your calculation seems to be relatively realistic concerning the market expectations.
Cool. Alexandros has asked, what are some of your favorite under the radar companies? For example, some small caps, maybe.
Yeah, I'm a little bit out of this. I still, of course, as a kind of hobby, follow the stock market, also German small caps, but I'm not that deep in that. I like a company called Bijou Brigitte. It's a company which might be a tenant of ours one day, but typically we are in bigger centers, bigger cities. When we have a small stores, and we sell cheap accessories for typically younger women. It has come down from much higher values to around 24-25. They had extraordinary margins for many years and extraordinary growth on that too. Were I think 2 billion at market value at the high end. Then they had many competitors coming in and were declining in margins and also reducing a number of stores. I think they had a kind of a stable new base before coronavirus hit, and that was really a big impact on them in 2020. They got a little bit better already, and I think with the stable base they have today, there might be a big chance they get a really profitable business next year, maybe already this year, second half. They don't have debt. They have huge cash, I think 17 euro each share at 24-25 share price. So the downside should be very limited. The upside might be a dividend yield of up to 8% next year or the year after that. So I think that's a relatively interesting share. Another share, German small cap, which I like very much, is STO, STO. A very strong growing company in the they're doing you have to help me on that. They're doing you can get with your building better closed to losing energy. I don't know what's it's called, demo
insulation.
Insulation, thank you. It's they also have strong dividend. They have the stock price was at close to, I think, 240-250 euro a few months ago. Unfortunately, I didn't sell. Today they are trading, I think, at 140, which is very much below the fair value in my eyes. But they also have risks concerning Russia, for example. I'm not that sure that they are able to fulfill all their contracts because of commodities not coming in or something. They of course also have the building branch might be a risk that because of the higher interest rates there might be declining building activities, but I don't think that that will hit that much. So I think that's also a company you might look at, especially with a really comfortable dividend yield, I think of 5% or something. Mm-hmm. Really good thing. So that's two stocks I think that also might be interesting for especially dividend growth investors.
So just for the listeners, we will put also the ticker symbols in the description of the show notes. And Matthias, then we have also a question from Ivan Baruta, and he's asking, are you planning to grow outside of Germany in the future? And if so, what will be potential areas for you?
No, simply no. There's so much potential in Germany. We estimate that in our segment, there are all over Germany 20,000 to 30,000 potential targets. Even if you take out southern Germany or the bigger cities, because they're typically too expensive, there's still more than 10,000 potential acquisition targets. We buy 8 of them every year, or did that the last years. Even if we double that, there's still it's a very, very small segment. We won't reach a size barrier in this life. So it doesn't make sense to expand to other countries with other building right, with other tenant structures, with our languages, all that. Even Austria or Switzerland, we won't do that. Yeah. Simple no. Yeah. Same as I already mentioned, we won't buy hotels. We won't buy logistic things. We stick to what we know, what we can.
Super. So Matthias, the next question is from Phil, and he's asking what your thoughts are about REITs and the American structure, which we don't really have in Europe or Germany. And do you have any thoughts about that as a CEO of such a kind of company?
Yeah, I'm often asked why we are not a REIT, as one of our directors, competitors is the Deutsche Konsum REIT from Mr. Elgeti, which does a very similar strategy, but is about 4 times, 5 times bigger than we are. REITs are not allowed to invest the same style as we do. For example, we are not allowed to finance that high. So we have to have a lower leverage, which means we have a lower yield on the own equity. On the one hand, you're also not allowed to do share deals. We did just 3 of them, but as a REIT, you wouldn't be able to do that. And sometimes investors only sell as a share deal. You also have restrictions. For example, if you have just a few, or you may have just a few flats in a building. Sometimes you have, I think it's the quota is 25% of the building. And one of our last acquisitions, for example, in Waltershausen, had 11 flats. In that, I think that wouldn't be allowed as a REIT. And there are other restrictions. For example, you have to take in your balance sheet in IFRS. We still have HGB, also German GAAP, as it's called, which is much cheaper for us. So there's a whole bunch of additional regulations which make sense, but only if you're much bigger. And on the plus side, you don't have to pay taxes. That's nice, but I think if you compare the performance of DEFAMA and Deutsche Konsum from the beginning, in the end, what was better for us to pay taxes, to be able to have a higher leverage and to get on that much better performance for the shareholders. So I don't exclude that one day in the future, if we are much bigger, we might change to a REIT structure, but we don't plan that.
Okay. And Mark has asked us, how about expanding the business model? Are there any other objects besides local supply centers that you would like to own? And I know you put a nice picture up on Twitter about this.
I just took a picture of what's it called, Burj Al Khalifa, with highest building. Looks very nice. I think if someone would give me that as a present, I wouldn't decline it. I also like, for example, castles very much, but rather as a hobby, or maybe one day, if I don't like to do business, I might be interested in refurbish an old castle or something, just to be proud of that. But as an investment, I don't think it's very lucrative. I think those not very spectacular retail parks are better for yield than those good-looking, great, extraordinary buildings like castles, like high, tall office buildings and all that. It doesn't look that representative what we do, but it's as an investment, it's much better. So no, we won't do things beside that. I already said that twice, I think, and I stick to that.
So onto the hard questions. So if times get hard and you can choose to only make one happy, would you first choose the shareholders or the employees, and why?
I would choose employees because we're still human. I think probably I don't hope that one day it's so difficult that we have to decide that paying our employees, or for example, don't be able to pay dividend at all. That would be a really extreme situation. We have relatively low personal costs in relation to our whole business. We only have about 30 people in the whole company. So that's not that problem, like, for example, a production company with thousands of people, and where you probably as a CEO one day, you have to decide whether the company should survive, and you have to take deep cuts in the staff or not. I think that will not be a problem for us. But if I really had to choose, I think I would probably try to keep the employees happier than the shareholders in this situation.
Good answer. Another question we have is, if you could own one stock excluding DEFAMA, what would it be and why?
I think it's very easy. I would choose Berkshire Hathaway, because that's you buy a whole bunch of portfolio of good companies with that. Not because of Warren Buffett himself, but as the portfolio is similar to a good diversified stock portfolio, and you get that on one hand. In Germany, you might get similar effects, not that extraordinary, with companies like, for example, Deutsche Beteiligungs AG, which is also a broad portfolio of companies in the German Mittelstand, but hasn't that great performance over the last decades. I also have a few of them, but it's not similar to Berkshire Hathaway.
And maybe let's take the last question for today, Matthias. And there's a question from Deep Value Ideas. He's asking you about your opinion of German politics on the real estate sector. I think, to be honest, it's a lot because of the butchering we see on the stock market around Vonovia. And then in the European dividend investors community, Vonovia is really a stock that many people are looking at from also from a dividend yield point of view, I think, and also their recent track record. So how do you look at the risks of the German political climate at the moment for companies, let's say, like Vonovia? And do you feel that DEFAMA is in any way exposed to that?
So I think already mentioned that one of our key things we have to deal with is bureaucracy concerning building right. You just have to deal with that if you're in the real estate market. In our case, it's on the one hand, it's great because it reduces competition. It's difficult to get permission to build a competitive real estate retail park on the other side of the road. On the one hand. On the other hand, if we have to change something in our buildings, we try to get 2 units together, like in Eberswalde, try to extend a food store or something. It's relatively complicated. It often takes months or even years, and sometimes it's simply not possible. And of course, also it's very expensive. But that's part of the deal. So for us, we know that we have to deal with that. If we didn't want to do it, we shouldn't be in this business. Concerning residential, it's a real problem because it makes building really expensive, especially in big cities. It also makes, of course, because building is expensive, rents are more expensive. It takes much longer to get new flats, even in cities where new flats are needed urgently. So I think that all this bureaucracy is a real problem. That in Berlin, especially, we also have things like Deutsche Wohnen enteignen. So we want to get rid of the company, want to get those flats in public hand, so to speak. That makes a psychological problem on top, which is a special case in Berlin. I don't think that finally something like that will happen because there are constitutional things that don't allow that. But of course, investors who don't understand that are really confused. Of course, that doesn't help to get investments in this segment. That wasn't a real problem in the boom time because it was really a good yield. You had great value growth, or you thought that was a value growth by investing in real estate, residential in Berlin. But it might be a knockout now as investing is getting more difficult, more risky, higher yields in financing. So that might lead to even less new buildings. and that will be a very big problem for especially people with smaller income who don't get affordable flat.
Yeah. So I think that's quite in line with the general sentiment, indeed, what we also read elsewhere. It's for us, probably because we don't live in Germany, a bit hard to grasp. But yeah, thank you so much for that clarification. So
I'm very unhappy that you left out the greatest questions I saw in all those. You probably can guess which I mean, that my pizza picks are, I quote, an elaborate long-term trolling move. I'm not sure whether he's really thinking I try to change the whole pizza culture in Germany, but I'm famous for posting my self-made pizza. And yes, there must be as much cheese as it's on my pics. That's the only pizza I will accept in my house.
Thank you so much, Matthias. I mean, it was really a pleasure to have you on the show. I hope it was also a pleasure for you to be here. I think many listeners, I think, got a really insightful picture of how you look at it. So thank you so much for sharing that with us and with all the listeners, actually out through all Europe and also in the United States.
Yeah, you're welcome. If we couldn't take some of the questions, just send me an email or give me a tweet on @Kumler or send it to you. I will try to answer all that within the next hours or days.
Perfect. Okay. Thanks a million, Matthias. It's been a pleasure. And again, to all our listeners and our community, thanks for sticking with us, and we will talk to you all next week.
You're welcome.